Thank you for this invitation. The theme for this second panel is future challenges. The future challenges for an organization, an NGO, like Finance Watch, is to make sure that we no longer have systemic banks. As you know, there is a list of 30 JSI-FI, out of which half are Europeans. And as I say, as long as there are institutions on that list, we do have a job at Finance Watch because we're here to represent civil society and try to have a look from a public interest angle to financial regulation. As part of these panels, we were asked 5 questions that I will try to answer. One preamble is compared to the first panel before us. I wanted to say that I was pretty much in sync with Mr. Stefanou from the FSB, and I salute the fact that he reminded some very strong facts about the impact of the crisis that we should not forget. Also, I heard here and there some criticism regarding the EBA. One thing that I want to emphasize here, because we're talking about future challenges of regulations regarding the financial industry, Mr. Andreas Enria says, and I want to quote him, is that the main contribution that finance can make to growth, because that's the subject nowadays, is to not create financial crisis. So the 5 questions that we were asked, and that I will try to answer. The first question was, what should the objective for the new legislative term be? Are there any unregulated areas left which need to be addressed? Where might a revision be needed amongst the already adopted legislations? So the objectives should be to address systemic risk and moral hazard. Since most post-crisis regulations, in fact, have been microprudential, it's time now that we crucially need to concentrate on macro as opposed to micro-prudential regulation. Within the new project called CMU, let's face it, shadow banking and too big to fail institutions, the GSI-FIs, are being promoted. So we also need to address the related risk urgently. In particular, we need to address the risk and the negative externalities of security financing transactions by introducing minimum haircuts and limiting the use or the reuse of collateral. We also need a bank separation that is not just cosmetic. We need revisions in CRD4, such as, for instance, removing the RRB models, not changing the standardized approach, redesigning the LCR, the liquidity ratios, to favor stable funding over liquid tradable assets. Question number 2. The question number 2 was, is there a need for an extensive review, or will some fine-tuning of the existing regulation be sufficient? There is a need for an extensive review of some core pieces of regulation, for instance, CRD4, but not with a view to deregulate, as is the case with the current consultation on CRD4 impact on lending, but rather with a view on implementing the Basel Committee recommendation to simplify the framework and make it more robust. Some recent proposals do fail to integrate the lessons from the crisis and the risk arising from imperfect and missing regulation should not be further increased by those proposals. In this respect, the revival of securitization should only promote truly simple securitization without conflict of interest and that finance the real economy. Financing the real economy means that the door should be definitely closed to synthetics. The definition that has been put forward currently does fall short of some of those objectives, and we do hope to see a tighter framework that will both address this risk and restore investors' confidence, which is one of the objectives. China's recent stock market crash is a timely reminder of the results of deregulation, excessive leverage, and pushing retail investors into capital markets. Question number 3. How should potential problems arising from the post-crisis regulatory measures, i.e. incoherence between directives and unintended consequences, be addressed? We need to keep in mind that the implementation cost of regulation and the possible small overlaps that do exist are minor impediments compared to the huge cost of the crisis. And again, many thanks to Mr. Stéphanou of the FSB to have reminded the huge cost of the crisis. So when assessing the impact of regulation, we should not just look at the short-term cost of regulation for financial institutions, but we have to keep into account the long-term benefits to society of such regulation. The Pricewaterhouse study that was up there in the first panel, one of the slides was quite interesting because you remember on that slide we saw that each of the regulation impact, what kind of impact, positive impact it had on GDP on an annual basis. When you add up, it's a rough number, but when you add up all those impacts, it's close to 3% per annum. 3% per annum when we have zero growth today. Wow. Last week, I was in Madrid at the IOSCO conference, and its Secretary General, David Wright, reminded us something that he also told 1 week before at the EBF conference here in Brussels, is that the crisis had a negative impact of 25 points of GDP lost worldwide versus the trend. So let us not drop the ball. Financial stability is key. Financial stability is a prerequisite for growth, sustainable growth, and jobs. Question number 4. Strengthened prudential rules for various market players could affect their ability to channel funds into long-term investments negatively. Can this be mitigated without threatening the financial stability goal for which these prudential rules were established in the first place? Well, in the first place, we do dispute the suggestion that strengthened prudential rules would affect the ability of market players to channel funds into long-term investment. If anything, it would lead to a healthy repricing linked with internalizing risk cost of negative externalities. It is also widely acknowledged that right now there is too much private capital looking to invest. We don't have a shortage of savings at all. The real focus should be actually to truly give incentives to these funds to invest long-term, something that is not currently being done. Current regulation like the liquidity ratio in CRD4, the so-called LCR, liquidity coverage ratio, continue to promote liquid tradable securities over illiquid assets such as loans. Changing this would contribute to promoting long-term investment. Investors have to become again investors and not traders, which they had become in the last few years leading to the crisis with that illusory market liquidity, where they didn't have to do their homework before buying a piece of paper. They just bought it, and they knew, or they thought they knew, that they could resell in the market that piece of paper if there was some kind of bad news. Well, we've seen in 2008 that market liquidity just evaporated like that, especially in the securitized market. Question number 5. It's going to be the last one, then I'm finished. Happy you. Third country rules should ideally eliminate regulatory arbitrage without reducing the access to funding from international investors. Have we found the right balance in this regard? For the purpose of promoting sustainable, very important adjective, sustainable growth and job creation, the question should be, how do we ensure that international investors' capital flow are not hot money, but rather stable long-term investment? The problem with hot money, it goes in and out, it's slushing, and it increases volatility. In this respect, several initiatives could lead to a regulatory race to the bottom, such as, it's a risk. It doesn't mean that it's going to happen, but the risk is there. The regulatory cooperation in TTIP, the new initiative called better regulation, and that's one concern for us. Thank you for your attention.